More than $300 billion in interest-only loans are set to expire over the next couple of years. The Mortgage and Finance Association of Australia, the peak body for mortgage brokers, estimates that 20% of interest-only loans borrowers will struggle to refinance due to tighter lending policies. So how do you manage your interest-only loan before and after it expires? Joining us for more is Marissa Schulze, Director at Rise High Financial Solutions. Marissa, good morning to you. This is something that's causing a lot of people a lot of worry. Who needs to be very aware about their interest-only loan and when it might expire?
Yeah, absolutely. All borrowers that have interest-only loan facilities, whether it's their home loan or investment loan, really need to understand what it means to have an interest-only loan and what it means when their interest-only period expires. So I think that anyone that has an interest-only loan or is considering an interest-only loan, needs to really understand what that means for them, not only during the interest-only period, but once the interest-only period expires.
One of the things we love talking to you about, Marissa, is that you're prepared. You're like the Boy Scout of housing because you always think in advance. And so how far in advance should people be thinking about dealing with this, and how far in advance can they deal with it?
Yeah, absolutely. I'm a big planner, as you know. Yeah. I always think that it's great to plan ahead and have a strategy and a plan for how you're going to deal with the loan once the interest-only period expires. I don't think it's ever too early to start planning for that. So when I say make a plan, it's really about knowing what date your interest-only period is going to expire, what your remaining loan term will be at the expiry, and what the repayments will revert to at that expiry date. Then your plan becomes, well, are you happy for that to happen? Are you happy for the loan to revert to principal and interest repayments and make that higher loan repayment? Or are you wanting to extend that interest-only period, which also requires prior planning? I think the earlier that you have that plan and it can work towards the outcome that you're looking for long term, the better.
How negotiable is it? How much can you negotiate the terms of your interest-only loan's expiration date? I mean, obviously there's a date when you sign the loan, but there's some wiggle room after that, isn't there?
So generally, if you apply for an interest-only loan, initially when you apply for the loan, you will apply for a definite term of how long the interest-only period will be. So a common term might be a 5-year interest-only period. So basically what happens is that when you get the loan, it might be a 30-year loan term. You might apply for a 5-year interest-only period, which means for the first 5 years the loan repayments are interest-only, but then at the 5-year mark it will revert to principal and interest repayments, which means instead of paying off the loan over 30 years, you're now paying off the loan over 25 years, which will mean that your principal and interest repayments will be higher at that point. So basically, if you decide that you want to extend the interest-only period at that 5-year expiry date, then that normally requires a full loan application to the bank that you're with, or refinancing the loan to another lender. That basically means that you have to go through pretty much the same process that you went through to actually apply for the loan in the first place. So the lender will want to see updated pay slips, they want to see your assets and liabilities, they want to see your living expenses to determine whether you can still afford that loan moving forward. And if your financial circumstances have changed, and we know that lending has tightened up over the last 6 to 12 months, which means that a lot of Australian borrowers can't actually afford their current loans based on the lender's policy as to what they already have in place. So it is going to be a lot more difficult for people to extend their interest-only periods if their financial situation hasn't dramatically improved over the last 6 to 12 months.
Explain what the obvious pros and cons are of staying on interest only or changing to principal and interest.
Yeah, so definitely there's pros and cons. I guess with interest only, it's great for cash flow because obviously you're making the minimum loan repayment possible. So it can also be a great tax strategy, or it can be a great strategy if you've got the strategy of actually paying down your home and personal debts faster and wanting to keep your investment debts interest only. So there's definitely a lot of positives as to why people use interest only loan facilities. I guess on the flip side, interest only loans do tend tend to attract a higher interest rate, so you are paying more interest over the life of the loan, and you could be seen to basically be delaying the problem. So ultimately the loan will have to convert to P&I, principal and interest, or you will have to keep extending it. If you do stay with the same lender and you extend the interest only period, say from 5 years to 10 years or 15 years, instead of your principal and interest repayments just being 50% more than your interest only payments, they'll end up being double what your interest only payments are when they revert to a principal and interest loan over a 15-year term. So I guess there are pros and cons, and you really need to be aware of the pros and cons and make sure that if you are using an interest-only period, that there is a strategy behind it, and you really know what the long-term strategy is around that loan and that property to ensure that that's the right strategy for that facility.
Now, it's hard to keep up, isn't it? Because this is a rapidly changing landscape. The regulator put one thing in place and now they've relaxed the rules on interest-only loans. What's the latest advice on that?
Yeah, so the regulators have relaxed the rules on the interest-only caps in terms of what percentage of new growth the banks are allowed to have in interest-only lending. That hasn't changed the lending policy, so that hasn't made it easier for applicants to get approval to extend the interest-only period. But what I'm hoping that we will see is that maybe the price differential in the interest rate between interest only and principal and interest, we might see that gap starting to close again. Because before the regulations came out, we had the same interest rate for interest only loans and principal and interest. With the regulations, we saw that interest only loans became more expensive than principal and interest. And perhaps now in the future, we might see that the gap or the margin between interest only and principal interest might reduce. That's what I'm hoping for anyway.
Yeah. You do mention, and we covered a lot on the show about the changing finance situations or access to the finance and the hoops and that they make you jump through now. What should people at home who are watching now, who find themselves in this situation, be starting to prepare to be able to extend their interest only?
Absolutely. When you apply for any loan application these days with the tighter credit policies, there are some things that you need to do every time, and that's regardless of whether you're applying for a new loan or trying to extend your interest-only period. Firstly, make sure you're working with a mortgage broker. Mortgage brokers have a wide range of panel of lenders. They can offer you choice. Every lender has such different credit policies. So finding the right lender for you is so crucial, and it's so difficult to do that if you don't have a great mortgage broker working by your side. So that's my first tip. I guess the second tip is living expenses are the big thing that are stopping people from doing what they want from a finance perspective. So living expenses are now being verified by most lenders, and what I mean by that is that they're looking at your bank statements and your credit card statements to actually verify what you're spending. And sometimes that can go back as far as 6 months worth of spending. So in the 6 to 8 months leading up to your loan application, it'd be really good to keep those living expenses as low as possible or as tight as possible, and to really try and have a good understanding of what your living expenses actually are, so that when you submit the loan application, your living expense estimate reflects the accurate position. I guess the other thing that we're going to see coming in over the coming months is positive credit reporting. So we're moving from an environment where only serious defaults have been recorded on credit reports. Now we're going to move to an environment where any overdue payments more than 14 days overdue will now start deteriorating someone's credit score. So people need to make sure that they're meeting all their financial obligations, that they're paying all their credit card bills and their car loans and their home loans on time, because if they don't pay them on time, that is going to start deteriorating their credit score and deteriorating their ability to get a good interest rate for finance. And I guess the other thing is that, to extend the interest-only period, especially if that involves a refinance to another lender, that can take 6 to 8 weeks. So if you're wanting to make sure that you're prepared for that, I would suggest starting the application process, 6 to 8 weeks in advance of when you'd like the new loan or the new interest-only period to commence.
Well, I'm surprised you're not exhausted trying to keep up with all the changes on the mortgage front there, Marissa Schulze from Rise High Financial Solutions, but great to know you're across it all. Thank you so much for your time this morning.
Thanks, Marissa.
Thank you for having me. Thanks.